Stop trading random order blocks. They fail 80% of the time, and if you don't know the difference between an order block and a breaker block, you're just fuel for the market. I'm giving you the only true breaker block formula that validates a definitive market structure shift and signals a high probability reversal. So how to identify valid breaker block? In bullish breaker, start with a bearish environment where price has been forming lower highs and lower lows. Identify a bearish order block that caused a previous downside displacement. Price returns to that bearish order block and reacts, but instead of continuing lower and creating a new low, it fails to maintain bearish pressure. Next, observe a liquidity sweep below a significant swing low. This is the stop-run component. Price must trade below a clear low where sell-side liquidity is resting. This sweep is essential because it clears resting sell stops and provides fuel for reversal. After the liquidity sweep, look for strong bullish displacement. This move must break above the most recent lower high, creating a market structure shift. The break of that lower high confirms that bearish structure has been invalidated. At this point, the original bearish order block that failed to produce continuation becomes the bullish breaker block. When price retraces back into that zone from above, it often acts as support, offering a continuation entry in the new bullish direction. Similarly, in bearish breaker, start with a bullish market forming higher highs and higher lows. Identify a bullish order block that previously caused upward displacement. Price revisits this bullish order block and reacts, but fails to continue higher with strength. Then observe a liquidity sweep above a significant swing high. Price must trade above a clear high where buy-side liquidity is resting. This is the stop-run phase, clearing buy stops and attracting breakout traders before reversing. Following the sweep, look for strong bearish displacement that breaks below the most recent higher low. This confirms a market structure shift to the downside. The bullish structure is no longer intact. The previously respected bullish order block has now failed. It becomes the bearish breaker block. When price retraces upward into that failed bullish order block, it often acts as resistance, providing a continuation entry aligned with the new bearish structure. The factors that should be considered when trading breaker blocks are summarized in 3 categories, including liquidity sweep, displacement, market structure shift. Let's start with first liquidity sweep. A breaker block is invalid without a liquidity sweep. Price must trade through a clear swing high or swing low where stop losses are clustered. This sweep is not optional. It confirms that liquidity has been engineered and taken before the structural shift. The sweep should be obvious on the time frame you are trading. Minor internal wicks without structural significance are weak. The stronger the liquidity pool, such as equal highs, equal lows, or well-defined swing points, the more meaningful the breaker setup. Second factor to consider is displacement. After the liquidity sweep, there must be strong displacement. Displacement is characterized by large-bodied candles, minimal overlap, and an impulsive move away from the sweep zone. Weak, overlapping candles indicate indecision and reduce the probability of a valid breaker. Displacement must break a structural level, not just create a reaction. The move should clearly violate the prior swing high in a bullish breaker or the prior swing low in a bearish breaker. Without displacement, there is no confirmation of order flow change.
Last factor to consider is market structure shift. The market structure shift is the confirmation stage. In a bullish breaker, price must break above the last lower high. In a bearish breaker, price must break below the last higher low. This shift confirms that the previous trend sequence has been invalidated. Without a clear break of structure, you are trading anticipation rather than confirmation. The breaker block is only valid after structure has shifted. Are breaker blocks just order blocks? Not exactly. Here's the difference. Order blocks are the original areas where institutions initiate positions before a strong displacement. They form prior to a continuation move and represent the last opposing candle before expansion in the direction of the prevailing trend. Breaker blocks, however, form after that order block fails and market structure shifts. They are created when liquidity is swept, structure is broken, and the previous order block flips its role.
Let's look at structural breakdown process of breaker block. Breaker blocks perform best when aligned with higher timeframe structure. Identify the primary directional bias on the daily or 4-hour chart. If the higher timeframe shows bullish structure, prioritize bullish breakers on the lower timeframe. If the higher timeframe is bearish, prioritize bearish breakers. Higher timeframe liquidity levels significantly increase probability. For example, if price sweeps a daily low and forms a bullish breaker on the 1-hour chart, the confluence strengthens the setup. Fair value gaps provide additional confirmation. If the displacement that creates the market structure shift leaves behind a fair value gap overlapping the breaker block, the zone becomes stronger. The confluence of a failed order block and imbalance indicates aggressive institutional participation. Execution should be refined on lower time frames, such as the 15-minute or 5-minute chart. After price enters the breaker block on the higher time frame, wait for a lower time frame structure shift in the direction of the new trend before entering. This reduces stop distance and improves reward potential. Avoid trading breaker blocks during low volatility sessions. Sessions with active liquidity, such as London or New York, provide stronger displacement and cleaner structure shifts. Let's look at some real chat example. On a bullish example, consider euro-dollar on the 4-hour chart in a clear downtrend with lower highs and lower lows. Price retraces into a prior bearish order block that previously caused strong downside displacement. The reaction is weak and fails to create a new low. Instead, price sweeps the prior swing low, taking sell-side liquidity. Immediately after the sweep, a strong bullish displacement breaks above the most recent lower high, confirming a market structure shift. The last bearish candle before the rally becomes the bullish breaker block. Price retraces into that zone, forms lower timeframe bullish confirmation, and continues upward toward equal highs, delivering a clean expansion. On a bearish example, consider British pound on the 1-hour chart in a sustained uptrend with higher highs and higher lows. Price pulls back into a prior bullish order block that previously caused strong upside movement. The reaction fails to produce continuation. Price sweeps the previous swing high, taking buy-side liquidity. A strong bearish displacement follows, breaking below the most recent higher low and confirming a structure shift. The last bullish candle before the breakdown becomes the bearish breaker block. Price retraces into that zone, shows lower time frame bearish confirmation, and continues downward toward equal lows with clean downside follow-through. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit that subscribe button and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next.